Bill says, I've been listening to 8 ways to manage a bull put credit spread and have a question, which might be addressed on today's webinar. You mentioned keeping a loss to around 50% of the invested amount. You're talking about 50% of the total risk of the net credit. And when you say full loss, is that on the risk or the net credit? Whenever I talk about 50% loss, I'm referring to the maximum risk. The most you could lose would be 100% of what you invested in the trade. You want to keep that at 50%. And related to that email about bull put management, when you speak of managing or adjusting the position when the stock falls to 1% above the short strike price in a bull put credit spread, how much of a loss would it be if you close the position at that point? Would it be full loss on the net credit? It's likely to be 2 or 3 times, probably 4 times the net credit, and close to that 50% loss when that happens, when the stock reaches 1% of the short put strike price. Fred, let's just go to bull put credit, and we're going to go to the search tool. And we're weekly bull puts. This is essentially sort of what's being used for what we call the weekly picks of the day. This is the criteria that I use when I start researching and analyzing which bull put credit spread I'm going to open. All right, so we have, usually the returns average around 15% or so, 14.9%. Again, I'm going to try to keep my losses to about 50% following the stops discussed in that 8 ways to manage a bull put credit spread video. But what is that related to? Well, AI has been hot recently, but that's a relatively low price stock. Netflix jumped up 10 points today. It's a decent move. All right, let's take a look at the Netflix position. I'm looking at a 2.5 point spread, receiving possibly a 40-cent credit at midpoint, which would give me a max risk of around 210 to 11. This would be an 18.8% return. Now let's go ahead and go to the profit and loss chart for this position. We're going to sell to open the 385 put, the stock at about 420. We're going to get $1.63. At the same time, this is the 23rd of June, 14 days out, sell the 382.5 put for $1.24. Midpoint prices, that's going to be about 40 cents or 39 cents or so. So let's just take this 5 out. Let's make that exactly 40 cents so it's easier to view. There we go. So we have a 2.5 point spread. We're gaining 40 cents of net credit, and I keep that net credits deposited into my account regardless of what happens, in theory. And what I mean by that is that's taken in, so it's realized in my account. If the stock falls below 382.50, goes to 380 or 375, and I don't take any action, what's going to happen? Similar to the rights and obligations we just talked about with the short strangle position. I've entered in an obligation to buy shares of stock at this sold put strike price, just as if I did a naked put, but I have the right to force someone to buy my shares of stock $2.50 lower at 382.50. So if I allowed this to go to expiration, stock was below both puts. My broker essentially buys shares of stock for me at 385, sells them at 382.50, and I take a loss of $250 or $250 per contract. But this 40 cents was already put in, so the maximum I could lose is $2.10 total. The 50% loss rule says that I am likely to close this position if the stock starts falling and moves down closer to within 1% of my 385 strike. So we'd be at 388.85. It's easy enough, right? But I want to make sure that I would close this position for a debit of roughly only 105. Okay. Now, that would still not take into account the 40 cents. I could allow this to go higher up to maybe 145, so my total loss would be 105 or half of the 210 that I took in. But I'm really going to start focusing on this 105, which just mathematically is what, Bill? It's about 2.5 to 3 times the net credit. That's just, a common number that comes up. It's usually about 3 times the net credit. They work out almost the same, depending again on strike prices and the credit. If you took a 95% probability on a 10-point spread and only took in 80 cents, for example, well, your risk is 920. Okay, so if you take half of that risk at 460, well, that's a little bit more closer to 5 or 6 times the net credit. So depending on where you are. What I've seen, what I'm trying to say, Bill, is my preferred approach, the 85% probability 2 weeks out of time. If I hit that 50% of the maximum risk, it usually equates to about 3x or 4x the net credit that I initially received. All right, now that being said, different strategies. We have different webinars where I've shown this before, not this way, but with actual trades. Let's just see. Down here below, calculate expected profit and loss chart. On the 19th, this is for the 23rd expiration, right? Yeah. So let's not go that far. Let's just go about halfway. So let's just go to 616. And what would my position be if it was at 385.85? Not 985.85. 1% of a short put, 385.85, Bill. Liquidation value of 93 cents. Right around the halfway point. About 2.3, 2.4% of the net credit. Falls to 385.85, 621, 3 days to expiration. The loss is going to be a little bit less. We're closer to expiration. It's only 76 cents. It's 2x the net credit. This is what I mentioned in my email to you, that the time frame also matters. Happens on the 13th. Happens on Tuesday. That's going to be about 99. Happens on Monday. Yeah, there we go. So we're right near that half of the maximum risk, or 2.5 times the net credit, roughly. So that was in the 1% rule, 385.85. No, I'm sorry, 388.80. I apologize. It should be 388.85. So it actually looked better. So yeah, in that case, there we are, 88. So 2x the net credit. But that also depends on volatility. And of course, again, I think you had mentioned somewhere in your email that, Delta could shift and things of that nature. There could be changes. But that's the idea. If the stock starts to fall again from 420 down to 388, the volatilities are going to move up, which would make the buyback costs higher, which might put that risk up to that 2 to 3%. All speculation and expectation, but you can see how the days remaining help the situation if the 1% rule is hit closer to expiration than a few days after you enter the trade. But yes, the maximum risk discussed, closing at 50%, is 50% of the maximum risk you could lose on the trade. I'm going to illustrate this one more time. I'll illustrate this a different way, Bill, I should say. And so this covers the follow-up. What would you think about how much of a loss would that be? It's going to be about 2.5, 3 times the initial net credit, but it depends on the timing of the trade. Talking about 50% of the maximum risk. Why is that important and why is that relevant? I'm going to go to radioactivetrading.com. I'm going to click on the Resources tab. And we're going to go to the Trade Simulator tool. Now, what this tool does essentially is you can put in your target return, expected loss you'd see in a given strategy. So if I'm doing a covered call, I might say, hey, I'm doing a month out covered call. I'm looking to make 2.5% if assigned, but I'm going to put my stop at 7%. So I put in 2.5 return of my investment. I'm going to put a stop at 7. And I'm assuming I'm going to be right about 70% of the time. So I'm going to put a probability of loss in is the opposite, 30%. I'm going to take $10,000 and I'm just going to open 2 covered call trades at a time. 50% of that $10,000 into 2 covered call trades. And this is my expectation. Slightly in the money covered call, put a stop at 7, expect a 70% success rate. And what this tool does is it flips a coin 100 times. Heads, you win and you make the 2.5%. Tails, you lose the 7%. And you see here it's 70-30. I only had a high value of 10,252. Had a low value after a string of losses here down about 7,758. Somewhere in this long run of 100 trades, there's a large set of losses somewhere in a row. 60, 70, it's towards the end there, isn't it? Nope, that's not it. Oh, there it is. Okay, so we're down here to about 77.58 at 84 trades in. And the ending amount over time is 81.94. Well, that's still essentially an 18% loss of the 10,000 I started off with. With this structure, I probably need to be right closer to 74, 75% of the time. Let's try that. Let's try 25% probability of loss. And it's random every time. But see here, even though that doesn't get you to where you need to be, you either need to control losses more, but that might wipe out previous winners and lower your success rate. But this is about bull puts. On average, I was making, in the good bullish runs and the medium bullish runs and even some of the hectic markets, the average return we're using on the weekly bull put credit spreads was that 40.9%. And we're going to control our losses to 50%. And we're typically right, success rate, about 83 to 85% of the time. And this 14.9% on average includes making full profit on some positions, making partial profits on others that maybe had to be closed, but we still had a profit on it, or just went slightly below the short put strike price. We closed the short put, but still at a profit. But in any case, probability of loss, let's put that at 17. So we're looking for that 83% success rate. I'll take the same $10,000, but I'm going to allocate this 33.3%. I'm going to open 3 bull puts each cycle. Now, this is not a projection of what to expect. This is a way to play with numbers to help you see what your stops are. Let's take this one, as I mentioned, 83%. Now, I want a different one. There we go, but that's 87%. Don't want that. 83. Good. It's a little bit better. Not great, but it's a little bit better. Why? I wanted to show some losses. Those first 2 runs of the 83 with the random flips of the coin was 7 or 8 winners in a row, so it never went below 10,000. This is more what you expect to see in a credit spread leverage portion of your portfolio. You're going to see fluctuations. I've been telling people, because it's happened to me, that every 15 to 18 months or so, you can expect the credit spread portion of your portfolio. And in recent volatile markets, whether they're bull puts or bear calls, if you're just doing the one strategy, every 15 to 18 months, you should expect a drop of about 35 to 40, maybe even 50% in the portfolio. That's the nature of these trades, even looking for an 85 or 90% probability, deltas of 0.1 or 0.08, because the unexpected happens, and when they happen, the lie of leverage works both ways. And you can see it here. At one point, over 100 trades, even with an 83% success rate, we are down 37% on the portfolio. But long term, you can make that up, and you can end up with a very high profitability after 100 trades. That's the nature of spread trades. You got to be able to stomach that. But what's the point? Why am I limiting the loss to 50% of that maximum risk, the difference in the strike prices minus the net credit? I keep the exact same numbers. We have to have an 83% success rate, of course, to be fair. But I allow the loss to go up to 65%. 84% win ratio. 1 point, wow, phenomenal. Only 16% drawdown. But over the long term, it's half the profit we'd see if we kept the loss to 50%. Let's try to get that 83. There it is. 20,000 at a high. Hey, that's pretty good. We saw 25 and 27 with a 50% loss. Portfolio down 40%, pretty close to the same, but ending amount long term, I'm down 12%. Not getting ahead. Let's let the losses go up to 75% of that maximum risk, keeping the same return on our winners and the same win ratio, 82, 83%. Almost went bankrupt, down 70%. That's an 82% success rate. Let's be fair. Okay, there's a winning one, but nowhere near what we saw with an 83% win rate compared to an 87, only making 16,000, allowing the losses. Trying to get to 83. It's random every time. I do apologize. That's, let me just, okay, it's going to stick at 84 for us. At one point, pretty much down about 72% and down 40% of where you started in the portfolio. That's why it's so important to control the risks to 50%. Also, in actual trading and testing, when I was going through the different criteria that I wanted to use, I found out that, why don't you keep your loss to 50%? Why don't you put it down to 30% with the same metrics? Because then you're closing out positions too often and your return drops down to about the 6 or 7% range. And it's still not enough to get what you can see. Different scenarios were run for the targets that were expected as well as the criteria that worked to get to those targets. And again, these are my targets for this strategy in the smaller portion of my portfolio, which should only be about 10 or 15% of your total portfolio. You're going to have different targets, and that's fine. But radioactivetrading.com, go to resources, go to Trade Simulator, run your numbers, play with what changes the most in your structure that you're trying to achieve by adjusting the winners and losers, the probability of loss, adjusting the loss limit to see how drastically that can affect it, taking half of the return to try to increase your win ratio from 83% up to 92 or 93, but does making half account for that to where it'd be better? I found it hasn't. Or playing with allocation itself. The sweet spot for allocation might be 20% or 25, following the Kelly criterion. You know, 1/5 or so, the 20% rule. But I just found out that I like to have 3 trades open at a time. So these are my ideas, what's worked for me, but you can play around with it and figure it out. Okay, so Bill, that addresses your 2 questions. The 50% is related to the maximum risk, the true maximum risk, difference in strikes minus net credit. For further insight on that, there is a full webinar, which you can look at here on the PowerOptions YouTube. And I think it's under clarification. Just search for clarification, if I spell it correctly without the J. Market sentiment tool. 1 year ago, clarifying suggested stops on credit spreads. And it's only 13 minutes long. We go through a little bit more on that as well, with different examples than what we use today and different concepts and ideas. But that's a good review to take on there for clarifying the suggested stops